Gary Wagner here. It is 11 a.m. in Honolulu, 4 o'clock in New York City. It is Friday, finally, the 27th day of January 2012, and this is the Daily Report, our weekend review. And oh, what a week we have had. Comments by Fed Chairman Bernanke set into motion a continuation of the first rally of 2012, substantially higher prices across the board. We'll talk about weekly gains in a little bit, but just for the day, up about $17 in gold, up over 1% on the day. Silver up 1.43%, up about $48. Platinum up $13 at $16.25. Palladium down $1 at $6.94. In today's report, I will cover in more detail the article which was published this morning, Running of the Bulls Part 2 in Kitco Metals on their website. I'll talk to you a little bit about the charts that I use, give you a little bit more insight and detail, as well as give you a full review on the week and what we are looking for next week, all here on today's Daily Report. Traders, you know that I have been a gold bull for quite some time. We entered our first trade, currently still in that trade, where we went long gold at 1580. That was on January 2nd. And when I took that play and actually recommended it to you, my subscriber base, the technical data was just forthcoming in terms of hardcore, non-refutable technical data which stated that we were in a bull run and that the correction was over. The data now is coming in because realize that the Western technical indicators will always lag behind the actual market itself. It has to. Most of it is average or oscillator based. The only real indicators that I believe are what I call forward indicators, rather than lagging indicators or forward indicators, are Elliott wave and candlestick analysis. That's why I use them. They're the only things that will tell you this is what we should see, rather than this is how the market has reacted on average to what we are seeing. The first chart we're looking at, this gold chart, is one of the charts that I used in my Kitco article, and it's really to just confirm, in fact, that we are in a bull cycle. Now realize we got in at 1580, so that would be right around this area right in here. And you can see that the market was just bottoming out. Of course, we had this extreme low here. I don't know anyone that would have gotten in that area. However, when we take a look now, roughly 3 weeks after the fact of taking this trade on, everything is starting to catch up. So the first thing that we look at is a simple moving average. It's a 30-day moving average. You can see that sitting at 1685, market at 1737. You can also see, in terms of a candlestick pattern itself, the initial pattern that I looked at was this engulfing bullish right in here. So that was the second thing that really caused me to think that we had something brewing in the woodwork. And if you notice, we are dead on the highs. We are absolutely on the highs of this day. Tremendous move in the market. This, of course, on a weekly chart showing you that we have had the largest single gain in 2012 based on a weekly gain. This gain that we had back 4 weeks ago was not nearly as strong as the market's move that we saw most recently. The last thing that I pointed out in this chart, and it's quite easy to see when you look at it, was this double bottom. And this, in fact, is what I was looking for. And this is based on my assumption that I thought we would basically see a flat correction, an ABC flat correction. We'll go into that in a little bit. And then lastly, your MACD, you can see that those are now crossing and therefore giving us good indication that we have moved from a bear to a bull cycle within this bullish super cycle. The next chart that I want to look at today is going to be our Heikin Ashi Japanese average. If you go to kitco.com and pull up the article, I've got a pretty detailed explanation along with the formula of how you create the Heikin candles for those of you who want to research it more. But you know from following my report, there's two basic things that I look for time and time again. One, candle size. do we have a large candle? And secondly, absence of lower wicks on a bullish run. Now, look at the last couple of days. Again, this is a daily chart. And these last 2 days have had utterly large candles, no tails on there. This trend is strengthening. We talked about this on Wednesday. What does this remind us of, traders? And I kind of pointed out this area right in here where you saw the market come up, as we did right here, consolidate, go sideways for a little bit, as we saw right here, and then begin to move up higher. We're having a very similar scenario. I see a lot of similarities in these two areas. Now, what does that mean? Realize that the largest rally we saw, this is the beginning of an intermediate 5 right in here, and this is the beginning of a intermediate 1 right in here. But what you are seeing right now is a very, very similar market scenario. And this last market scenario, think about it. It took us from roughly $1,400, just above that, just say below $1,500 right in here, to about $1,920, a record high. In other words, we saw a $400 move on this rally. On this rally, we've got $200 at this point. You've got 1530, 1737. So you've got over a $200 move so far. Do I think there's more in store? I'm going to have to say there's a high possibility. Now, where are we looking for resistance in this particular market? Well, 1750 is my first area. My daily subscribers, you know that I've talked about that quite some time. And then you've got another real band of resistance right here at 1800. Now, the interesting thing is that when we do some basic Fibonacci retracements, you're going to see how these numbers match up. Let me put them up on the screen for us. Now, traders, all I have done is created a simple Fibonacci retracement starting from the beginning of the rally in July to the record top. When I do that, I look at different retracement points of interest right now as we're moving back up. The 61% retracement, 1749. That would be the first target that I look at. As I said, 1749. That's a 61% retracement. We're pretty close to that. And then my second real target is going to be just below the 76% retracement area. It's going to correspond with these sets of tops here. It's going to be right around 1800. So I think that this zone here could offer a little bit of resistance. These are the two areas that we're going to look at. Of course, traders, we basically entered this trade at 1580. We then added a leg right around here, and then we added one more leg right around here. So some traders, the aggressive traders, are now holding on to 3 legs of a position. We're going to maintain that. We're going to maintain our long, of course. We're going to see what happens next week. I still think we have a little bit of room to the upside. But traders, realize that once we see the culmination of this first rally, we will go into a corrective wave. Now, wave 2 is typically a sharp corrective wave. It can be up to 61% of the move that we witnessed up. So we want to be careful around there. Do I recommend going short? I'm really not a short market player, especially when we consider the kind of bullish cycle that we have. But for those who are, when we sell, you can probably go short. We'll simply sideline and look to buy back in on wave number 3. You know, of course, the big story right now has been the dollar. That's kind of what's been setting all of this into motion. Take a look at this Henkin chart. This is a dollar index. It's the daily chart. You can see that this market has just really moved in a direction that is counter to any kind of a strength. And when we consider, let me kind of run that by us. When you consider the kind of move that we saw from September up through October, then back down through November, then November's tremendous rally from 76 to about 82, well, we're now giving back a good portion of that. And this market, I think, is destined right now to go a little bit lower when I talk about the dollar. Lastly, let's look at the stellar performer this week. That's got to be the silver market. We'll start with our weekly chart. Look at this. 1, 2, 3, 4, a month of solid gains. Of course, we are long at 28.10. Not a bad position right now when you consider we've got about $5 on the trade. We're here. Of course, the market is a lot higher. Where do I expect a little bit of resistance? Well, my first target point that we've talked about, and we'll look at the different areas, but that's at $35 area, 35 and change. You can see these sets of tops right in here, and that's going to correspond to the area where I think we could find some resistance. Our next target, of course, has got to be at around 37.50, 37.60, corresponds to this bottom. And let's take this one step at a time, because my belief is that there's a lot of room to the upside in silver. Let's just see how it wants to play out. Let's look at our daily Henkin Ashi. Let me go ahead and blow that up. 35.31. That's my first target area. We've certainly surpassed that 31.92. And so when we look at this marketplace itself, this is going to be our target right now, 35.30, 38.07. and then $40.82, $41 per ounce. These are my three targets. We'll have to look and see, because at some point we are going to get some sort of a corrective wave. We want to be ready for it. We've got absolutely beautiful profits in here. For those that are trading the futures, we've basically doubled our money on this first trade. We want to hold it. This has been an exceptional week for gold bulls, silver bulls, and precious metals traders. Thank you for spending your time with me. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.
Underlie the participants' projections of growth, unemployment, and inflation that I just described. Rather, importantly, these policy assessments should not be viewed as unconditional pledges. Rather, just as with our economic projections, these policy projections reflect the information available at the time of the forecast and are subject to future revision in light of evolving economic and financial conditions. In the chart labeled Appropriate Timing of Policy Firming, each shaded bar